Good morning. This is Irfan Ibrahim, and welcome to the second webinar of the Energy Blockchain Consortium. I'm pleased to introduce Tony Giroti here today, who is going to be talking about the basics around the concept of blockchain, and he will get into some specifics of how it can be used in different applications. So with that, Tony, welcome to the forum.
Thank you, Irfan, for moderating this webinar. Thank you, everyone, for joining from all over the world. Welcome to the second webinar in the Energy Blockchain webinar series. So our topic today is blockchain basics with focus on energy. And my name is Tony Giroti, and I will be your presenter today. Let me introduce myself. I've been in the IT industry for over 25 years, designing and developing mission-critical distributed computing platforms and applications. I have also architected massively parallel supercomputers at the Kendall Square Research. I'm an entrepreneur at heart. I've founded a few companies, and the last 12 years I've spent in the energy industry in the areas of smart grid and now in the energy blockchain space. I'm also a former council member of the Department of Energy Gridwise Architecture Council and the founding member of NIST, SGIP, and a few other organizations. Currently, I'm the chairman of the Energy Blockchain Consortium. Thank you for joining. Okay, before I begin, I just want to make sure that I have a quick disclaimer that any product, individual, or company we mention in this webinar is not to be construed as our endorsement. We avoid the use of these names, and any mention is purely coincidental and for illustration only. And I just want to mention that. So just a quick blurb on this series. The Energy Blockchain webinar series was created by the Energy Blockchain Consortium. Today is the second webinar. It's free to anyone registering. You don't need to be a member. And it's conducted on the first Friday of every month, except the holiday week, which is last week. And here is a number of dates that the webinars are scheduled for. They're also available for offline viewing for those of you viewing offline or interested in doing that. And about the Energy Blockchain Consortium, it's a non-profit consortium of companies who are interested in using blockchain technology to solving the most compelling problems in this industry. And you can get a lot of information by visiting the website. So let's get started. Okay, the way I'm going to do this today is that we will start with a recap of the blockchain from the last webinar. We'll talk about what is blockchain, how does it work, and as usual, I'll give a simple example and just walk you through it. The core focus for today will be to talk about what is under the blockchain hood. I got lots of questions last time as to what is there in blockchain. So I'm going to demystify the whole thing. I don't want to use the word architecture because it sort of becomes a little bit difficult to understand. I'll keep the concept high level, but I'll talk about distributed ledger, smart contract, what's its consensus, and how does blockchain make stuff more secure? We've all heard about it, but we'll talk about that today. I will also talk a little bit about the cryptocurrencies and wallets. And I'll give you a very interesting example around a P2P transaction, like an end-to-end transaction that will be conducted from two different users. And we'll talk about security and how we make this transaction secure. It will be quite an interesting example. And then we'll talk about an energy blockchain use case and a few next steps. Okay, so first thing, what is blockchain and how does it work? For those of you who were there last time in the webinar, I had presented on the 1st of June. You know this slide, but I'm going to quickly walk through for those who are new today and also for a recap for those who attended. Okay, so what is blockchain? Blockchain, the world we know today is basically driven without blockchain, most of it, obviously. There is a company could be a bank, a utility, They have applications. They have many applications. They have business logic that drives those applications, and they have databases. So all of the control is basically centralized with a company, whether it's a bank or a retailer. And the business logic is run by the company itself. So when a business logic is run by the company, they control the data. And who do we trust? We trust actually the company itself, because they've been working for years with us. So we trust our bank because the decisions are made by the company. The company knows the history of the data. Any changes that are made to the data are known by them. So they are the trusted party for us. In the blockchain space, it's a whole new world actually. In blockchain is actually the next generation of distributed computing platform. If you remember, I said that, where you have nodes which are scattered across multiple different companies or domains. And each node is basically an autonomous node. They may have different components of a blockchain. Usually speaking, they will definitely have a distributed ledger, a ledger which controls and has the data. And they have a smart contract, a business logic, a process that basically allows them to manage the data. So what happens in this case? Why is this different than the world before? The reason it's different is because the control is actually, when the control is decentralized, what that means is that not one company controls this data. The data is controlled by who is the controller of the data? The data is actually controlled by the business logic, which is the smart contract. And the smart contract is one way to ensure that the data is consistent and pure and tamper-proof. So the control is not in one company, but it's scattered, and each node is autonomous. So who do we trust? We do not trust a single company. Therefore, the system is designed to achieve a trustless environment, which means that we don't trust individuals, but we trust the encoding in the smart contract, which basically drives our preordained results. That's quite unique about blockchain. And there are a lot of capabilities of this blockchain that is driven by certain consensus. We talked about that last time. It's driven by the provenance, which is the tracking of the data. And the data itself is immutable, does not change. And any transaction that occurs has a finality to it. But that is consistent with even the world today. A transaction does have a finality. But the biggest difference is if you decentralize control and a replicated data across multiple nodes, which are controlled by different entities. All right. So how does blockchain work? All right. So let's take an example where Andy sold 3 widgets to Bob. In this particular case, when Andy sold the widgets to Bob, in a traditional model, the widgets were sold and the transaction was tracked. But in the blockchain world, basically, the transaction has to be tracked in a way that it persists. So in this particular case, a company A, which has a node A, has a smart contract. The smart contract is the business logic that basically manages this transaction. So now this particular transaction is created, which is Andy sold 3 widgets to Bob, and at the rate of $1. So Bob should owe Andy $3. So node A creates a digitally signed transaction, which says that 3 widgets were sold from Andy to Bob, and $3 are owed by Bob to Andy. That's your transaction X. And then this transaction actually gets pushed onto the second node, which is your blockchain node B, where you have the smart contract, which again does the same thing. This node says, okay, I got the data, but I need to verify that. I trust it, but I have to trust it in a way that I can do my own verification. So it looks into whether it complies with the rules of blockchain. Yeah. Is it digital signature okay? Yeah. The company A is indeed company A. Are there any conflicts with the previous transaction? The answer is no. Then the company B says, okay, I like it. I'm going to put it into my memory pool, which is my provisional unconfirmed transaction pool. Now I have transaction X in my system. So now the same transaction propagates into company C, and the company C goes through the same verification process of compliance with the rule, digital signature, and we'll talk about digital signature today. But the company C does the same thing. It puts it into a memory pool, and boom, now we have the physical data in 3 different nodes. So now how do we create a block actually? This is one of the unique things about a blockchain, the creation of a block. Somebody who is a validator comes up periodically, looks into this transactions and says, I need to validate this transaction. And the whole concept of a validator, if you recall, is basically the way we create consensus, and I'll walk you through that. But for the sake of this discussion, the validator comes in and says, I need to validate these transactions. It validates it, and it creates a block in your ledger C. And this block has about 4 different things. It has its own hash, so it's encrypted. It's got a timestamp when it was created, and it has these unique transactions, PX and PY, for example, which were together executed and could be blocked together. And it creates a link to the previous hash. And that link between the previous block and the previous block has a link towards the previous block results in a chain of, and hence we call it the blockchain. So from a application perspective, how does that work? A blockchain application can be created using blockchain technology to create a business rule where anybody who sells a widget to anybody else is sold at this particular rate, or there is a discount of X percentage in selling Y units. That type of a business logic can be encoded in a blockchain smart contract. So when you execute these transactions over time, what happens is that these blocks start to get created. When these blocks start to get created, they get distributed. They get distributed and they get connected through the previous block hash. And the blocks are connected based upon this chain. And this chain kind of is perpetual, and the blockchain keeps on growing forever, basically. Okay. Now that we have recapped on what is blockchain, how does it work, and what's an application look like, now let's look into what actually is inside the blockchain. Okay, so I call it blockchain under the hood. All right, blockchain is not something to fear about. We've had distributed computing for years now. At the base of all of these technologies is nothing more than your traditional operating system, networking system, file system, databases, if that's the case. So what is blockchain then? Blockchain is that middleware that provides you with the environment to process all of these transactions. For those of you who are familiar with the word middleware, this is consistent with the middleware that we've been using for the last 30 years. It's gone through an incarnation from AOSF DCE to Corba to Java, J2EE to .NET. All of these things are called middlewares. And these middlewares these middleware technologies provide you with the environment to execute transactions. So the blockchain middleware gives you the following things. It gives you a way to have fault tolerance. What that means is that if a node breaks on computer X, then all other systems start to become aware of it. And that level of higher availability is a prerequisite in a public network like this. We also have the ability to do virtual machine. We can create virtual machines. We can actually timestamp the data. One of the key aspects of a blockchain is the way it actually processes a transaction. For those of you familiar with online transaction processing and secure messaging, will be able to relate to it. This is nothing unique. The uniqueness is the way it does it in a distributed way. That is very, very unique, but it does transaction processing. It also has this unique capability to process blocks through a verification and validation process. The accounts and addresses is not unique to blockchain because we've been having UUIDs, universal IDs, and X.500 protocols forever. But what is unique about blockchain is the way the accounts and addresses are managed because it's a public network. So we are in a very uniquely using the public cryptography to store the data and to provide access to the data. Very unique. Similarly, there are other capabilities around transaction management that are very important to the success of blockchain. So all of these linkages, the distributions of these transactions are basically facilitated by blockchain technology. So when you have a blockchain vendor, a company that makes blockchain, what they're doing is they're actually creating this middleware, which you see in front of you, basically. Okay, what else do we have? What else we have is on top of this middleware, we have the stuff that we know about. We have heard about. When somebody says blockchain, they rattle off that it's a distributed ledger technology. So these are the functions which have taken prominence because they have an importance and a public face to it. And these functions are called the distributed ledger. The word function is not important. What's important is the value that is created on top of the middleware. Distributed ledger is one, smart contract is another, decentralized consensus, we'll talk about that. All of these things, public and private key security, the cryptocurrency and the wallets, and many, many algorithms such as the hashing algorithm, the BFT algorithm. So those are the functions and capabilities that the blockchain vendors have actually developed on top of the blockchain middleware. So the middleware and the functions are sort of part and parcel of the blockchain. Then when people talk about blockchain, they're usually talking about a feature that it is immutable. If you remember hearing and talking about blockchain, people talk about it's a trustless environment. People talk about it's a democratization of the ecosystem. So all of these things, the immutability, the trustlessness, the provenance, the finality, the democratization, and the disintermediation are the features that can be implemented over blockchain. So when you talk about a blockchain, the middleware, the functions and features are basically all packed together, and that becomes your blockchain. So Ethereum is an example of a blockchain. R3 Corda is an example of a blockchain. We have Hyperledger, which is an example. Hyperledger Fabric is an example of a blockchain. So those are the greens and the middleware and the functions and the features. This is what those blockchains provide. All right. So now, what else do we have? These blockchains also have the language, a way to create some business logic. We have languages like Solidity, Go, Java, Kotlin, a very interesting thing called Legal Prose that R3 Corda has. And there are other languages as well. Languages that people use to create the business logic, for example, to create a smart contract. And then on top of that are the applications that developers use. So a developer doesn't create the middleware or a function or a feature or a language. He or she gets it out of the box. So what they do is they actually create a smart contract. They actually create some type of a cryptocurrency. They create some type of a way to exchange with a fiat currency. Fiat currency is dollars and pounds and euros, etc. They may also be able to create a proof of maybe authority algorithm. Maybe they can create a proof of stake algorithm. They can some genius may also create a proof of work algorithm. So all of these are the value adds you add as a developer on top of the blockchain. So that's basically what the blockchain under the hood looks like. Some people would call it architecture, but architecture can become a little bit more detailed. But this is a 20,000 foot level view of a blockchain. All right. So when you have this thing called blockchain and you have the world of blockchain, how does it work? The way it works is that each of the nodes is independent, like I said last time. So each node must execute the entire stack. So it has more or less the entire stack. I won't go into the details of it or the nuances of a virtual machine, but the idea is conceptually, each node is basically has the autonomy to do everything. So it must run a full stack, or it should, if you open up the hood in a node, you should see the blockchain working basically. All right. So these are different ways in which we talked about last time, how do we build consensus? So one way to achieve consensus was through the proof of work. So proof of work, we talked about last time. Where does the proof of work sit? I mean, who are these people? who does that validation? These are people, these are validators who have their large data centers and computers who are basically doing data mining. They could be a company that does not need to be company B or company C. This could be a company X. And these companies are sitting outside the blockchain to do the data mining so that they are able to prove these transactions and validate these transactions, basically. And how do they make money? They will make money through that mining process by validating those transactions. All right, so let's talk about these core functions of blockchain. I'm going to focus on these 5 functions, which were the top layer from on top of the middleware, if you remember that. Okay, we'll talk about the distributed ledger. What is it? Smart contract, decentralized consensus making. What is a public-private key security? And a little word on the cryptocurrency and wallets. And when we do all of these 5 things, then I'll give you a transaction, which is a peer-to-peer transaction. That will bring all the pieces together. All right, so let's talk about the first thing, the distributed ledger. Distributed ledger. When anybody talks to you and says that distributed ledger is a distribution of the database, the obvious question I ask is, you've had distributed databases for years. As far as I know, I've been using it for 20 years. Why is distributed ledger such a big deal? That's a question that we should ask. Here is the answer to that. The world we have today, yes, we have a company that has complete control, but this company can have distributed databases. The whole world of telecommunication and banking is based upon the fundamental concept of having a distributed database. We've had it since 1988, 30 years ago. This is not unique. So, what is unique then? In the good old days and today, we can even replicate the database. Still not a distributed ledger. Okay. In the good old days, we were actually controlling these databases as a single company. Now it starts to get interesting. So if you remember the world of blockchain, we are synchronizing database. I showed you that earlier. We are doing synchronization, but we're doing it with validation. The company B says, I get stuff from you, company A, but I need to validate that based upon my smart contract and the rules of the game. So there is validation. In the old world, validation is optional. It's my own company. Why should I validate? Maybe I will validate, but there's no requirement for that. I can use any application from a big company and achieve my objective. The difference is validation. No one trusts anyone, so therefore we have to validate. All right, that sounds interesting. Still, we haven't really, there's no aha moment yet. Okay, so then what? Second thing is that no single company controls the data, which means that if no single company controls the data, now it starts to become interesting. How is it even possible, actually? The other areas are that who controls the addition of data in the distributed ledger? In the good old days with the world today, the application business logic does that, right? Which is controlled by a company. But in the new world of blockchain, it is a smart contract, not the company. And who is the smart contract? It is we as developers who have envisioned a business logic that will therefore, going forward in the future, control this ecosystem or a business logic, which is Andy sold 3 widgets, X widgets to Bob, and Bob owes Andy $3 based upon the business logic. So that's the business logic, which is encoded. Now, business logic can be encoded in the world today. The difference is that that business logic is spread across all different computer systems because each of them is autonomous. That's very different. And now the next thing is who actually controls the data in DL, distributed ledger? Well, think about it. It could actually eventually be the end user as the ultimate controller. You and I are eventually the ultimate controller because we're not depending upon a single company. We can actually now control the destiny of our own data. I can decide who gets my patient health, my own patient's health record. I can decide how my energy data is used. I can decide what I want to do, what choices I want, what energy I want to use, what is the quality of energy. I can decide what attributes are important to me. That's where the decision making comes in. I, as an individual, can become an ultimate controller, not a company who I tell something to do. So unlike other traditional databases, data in distributed ledger cannot be deleted. Yes, we have organizations who have those rules, but as a foundational attribute of a distributed ledger, data is immutable. Thou shalt not delete the data because it is undeletable. All right, so that's your distributed ledger. Now let's talk about smart contract. Smart contract, the way I thought, I don't want to rattle off a meaning of smart contract to you through a bullet item. I don't want to do that. So I put together some type of a comparison from a traditional from a traditional contract, just to give you a sense of the evolution of a smart contract. Why are we even doing this, or what is the benefit of this? So if you look into a traditional contract, it could be paper or electronic, but Nick Szabo actually coined this term of smart contract. The word is not always smart contract. The word is chain code in Hyperledger, but it is the business logic and the smarts that controls the databases and the application. Okay, so what actually is it? If you look into a traditional contract, it's a piece of paper or even an electronic format. It is the terms of how the relationship between two parties will be governed, the terms themselves. But a smart contract not only defines those terms, but it also controls how that is processed. Now, in the old world, which is traditional contract, a person, a human being, is the arbitrator. Because somebody can go to him or her and say, you know what, they didn't give me the key that they were supposed to give me. I already paid them the security deposit. I need my key to the apartment. In case of a smart contract, that transaction is controlled. You will not get the key unless you pay the security deposit. So the transaction is controlled through the contract itself, which is very, very important to understand, which wasn't possible up until now. Who creates this traditional contract? It's an attorney or an intermediary who does it. But in case of a smart contract, it's an entity, a business who really wants to offer something with zero overhead or a low overhead. Think of it like that. It's kept in a distributed ledger compared to a traditional contract. It's kept physically in a ledger, or it's controlled by the smart contract itself. It's perpetualized, memorialized forever, actually. In fact, there was an event in the Ethereum Continuum 2 years ago where there was a big flaw they discovered in the smart contract. And now there was a predicament. Should we modify the smart contract, or should we continue with the bad version of the smart contract? And that was a perplexing moment in the history of Ethereum. Each of you should probably read about that. Because now, by the rules of the game, you can't change the smart contract because that's your rule. And all of a sudden, you realize that your smart contract is flawed. So how do you address that issue? And that issue was, by the way, addressed. And it was addressed through an interesting model where the founder stepped in and he said that let's go back and change the contract, and which is contrary to my belief, but that's the only way to go forward. And some of the purists decided to continue with the old chain. So then we had two chains. It became more and more complex. But over the years, the world has gone back to what the founder of Ethereum had professed, and now the world is continuing on that chain. So there is a lot of perplexing moments which have occurred in the history of the smart contracts, and what I'm giving you is an example that is a well-known example. Can this be changed? Of course not. We are talking about immutability, but the problem I just gave you tells you how the whole immutability can become an issue. So there are ways in which we have to address that. Number 6 is tampering. Is tampering possible with a regular contract? Of course it is. Anybody can change something, and because there's no viable means to track it, and things can change actually. But the way a smart contract is written, because of its immutability and the fact that the log is maintained, tampering is not possible. 7, who executes the transaction? Basically, it's an agent, right? It's an agent or an intermediary who basically says, I want to get X percentage of a transaction. But in case of a smart contract, it's the business that created it, which offers some incentive to the creator of a block and says, hey, dear block maker, I will give you 0.1 cent for every dollar, but spare me your 30 cent. I'm going to let my buyer and seller benefit from the transaction. I don't want any intermediary. So I'm going to take 0.01 cent and you take 0.01 cent and we're happy campers, something like that. So you're able to reduce the intermediary cost or even eliminate it if this was encoded. So who's the intermediary? It is actually indeed no one in a smart contract. It's actually the contract itself that becomes the intermediary or the arbitrator. Is there a risk of litigation? Yeah, obviously. Smart contract, the whole business of law is designed around litigation, or fear of litigation. So in a smart contract, believe it or not, there's a guarantee of a specific outcome. And that's why they say the smart contract should be as simple as possible. Because the more simple it is, the more easy it is to execute. So there is a fear of litigation is almost zilch to none, but we are in the early stages of blockchain and you will see some dissonance. But technically, the smart contract is an airtight piece of document, except for some of the anomalies I talked about. Security, extremely high with a smart contract. It's unchangeable. You can't tamper with it. It's cast in stone. Boom. What do we do? It is what it is. And from a legal jurisdiction perspective, it's very clear. You're working in a Commonwealth of Massachusetts, or you are in a particular state or a country. Jurisdiction is very well defined. In case of a smart contract, we are still in the early stages. It can be managed, but we are still in the early stages. Now go look into the right side of the slide. Benefits of smart contract. You get accuracy. You get built-in governance. You get the autonomy. You have reduced risk. You have transparency, immutability, trust. These are all the benefits you get from a smart contract, which was not possible with a traditional contract. So therefore, it's a very highly desirable instrument that has gotten so much press and publicity that this is one reason why we are talking about blockchain and why blockchain has such a phenomenon. All right. So high level view, what does a smart contract do? There are 6 things that I want you to think about when you look into a smart contract. First thing it does is it basically provides you with a business logic. You know that now really well. And don't worry about the Turing completeness. Turing completeness is a concept in computability theory that it says that a computer program will try to mimic something that it wants to do. So if you have something called as a Turing equivalence, don't worry about that as well. But the idea is to be able to make sure that we can create as crisp of a smart contract as we are envisioning. So therefore, the business logic is the encoding or the software that developers write to make that business logic. 2, it actually replicates the assets, the data, the distributed ledger. It operates, it governs, it manages it. It allows you to control it in a way that it has the autonomy. Nobody can go into the distributed ledger and update it. That is a travesty. Nobody can do that. It gives you the security with the cryptography and the hash chains. The reason the data is immutable and unchangeable and trackable is because of the way the data is protected itself. It's unlike the way the world exists today, where data can be exposed. Even in the world of GDPR, the data can be exposed and prone to compromise. I'll actually walk you through an example as to how data can be made even more secure in the next couple of pages. Number 4, contract execution. So remember, not just the definition of a contract, but the execution of a contract is also one of the most important things, which means governance and control, for those of you familiar with that nomenclature. The Byzantine fault tolerance, what is this thing? This thing is very, very interesting. This is actually one of the core capabilities of a blockchain, a good blockchain, might I say, that allows you to have fault tolerance. I mentioned that earlier on, right? A fault tolerance, BFT, by the way, comes from that Eastern Roman Empire, the Byzantium Empire, and it's an algorithm proven in the military strategy where you identify rogue generals or the enemy soldiers amongst friends. And similar to the world of computing, where you have nodes scattered all over the place, you don't know if there is a rogue node or not. This capability allows you to identify the rogue node and allows you to identify, more importantly, a node that has faulted. Because if that occurs, we can't really just be happy with it, it's gone forever. We have to act on it because it's a fault-tolerant system. For those of us who are familiar with the fault-tolerant and high-availability systems would know that there's a lot of work that goes into ensuring that the system stays fault-tolerant and highly available. And the last but not the least is the entire focus around transaction management. How do you take a transaction? How do you process it? How do you ensure that it gives you the asset properties, the atomicity, the consistency? I don't want to go into the details of it, but the idea is that all of these properties are basically epitomize a transaction, the validity of a transaction, basically. All right. Now let's talk about what is consensus. How do we achieve it? And by the way, it's decentralized. That becomes more interesting. Now, for those of you who were in the previous webinar will be able to relate to this slide, but I wanted to talk a little bit about how the validation occurs, how the transactions are validated, how the blocks are created, who creates this agreement, who's in control, and why do we call it trustless? Let's walk through that right now. There are different algorithms that provide consensus, the proof of work, the proof of stake, and the proof of authority. And there are a few more, but that's sort of where the world is right now. In an open blockchain, where you have anyone joining a blockchain, like for example, the Bitcoin blockchain, we need some way to validate those transactions. Remember those transactions in the early pages I talked about? You need to validate those transactions. You need to create blocks from the transaction. So all of these people who are interested in becoming validators, these people basically say that, hey, I'm going to actually validate. I'm going to create a huge computer system and I would validate this transaction. So what they do is they basically have to solve a mathematical problem. It's literally nothing more than that. They actually have to solve a mathematical problem, whether it's a hash function, a reverse of a hash function, some kind of an integer factorization, or some kind of a new puzzle protocol. They solve a math problem. And when they solve a math problem, one of them is a winner, one of them is a leader. He or she, in this case, a computer system, it becomes the miner. And this leader, who is now the miner, basically creates a block. Why? Because he or she goes into the computer, looks into the transaction, validates it, says, aha, I verify it, and it creates a block. Once a block is created, this leader gets financially rewarded. Think about it. Where does the money come from? The money comes from that $1 that Andy and Bob, when they did the transaction, when Bob paid those $3 to Andy, a very small portion of that, of the $3 is actually delivered to this data miner. So as opposed to an intermediary who probably gets 10 cents or 20 cents or 30 cents or 40 cents on a dollar, we've eliminated the dependency on intermediaries. Now it's the POW data miner who basically gets a very small, tiny fraction of that $1. And that's how he or she is rewarded. But the amount of computing power that is needed, it's like 32 terawatt hours per year. That is sort of humongous, actually. And we talked about this last time that there is one way in which the entire blockchain can be hijacked, a public blockchain. If you have over 51% of the mining done by one individual, there is a risk to that. Now, that is highly unlikely because even the founder does not control more than 4.5% of the first blockchain. So therefore, the risk of that is minimal. But nevertheless, that computing power is one of the biggest issues in the POW. So we came up with a new capability in this industry called the proof of stake. Proof of stake says that I'm not going to depend upon this humongous computing power to do the validation. I'm going to use my stake in the network. So therefore, that stake allows them to do the validation, and you would need a minimal percentage of stake to do the validation. So we've eliminated the dependency on raw computing power, but instead introduced the stake as the ownership for the responsibility to compute the block. Quite an interesting thing. And POS is usually used in a permissioned-based blockchain, which is not open, whereas a POW is usually used, actually always used, in a public blockchain, basically. Proof of authority is yet another version of proving and validating the data. This is through some authority nodes. And in the utility market, and even in the other industries, whether it's logistics or supply chain or obviously energy, any industry, the early versions of this will be permission-based. FinTech has done tremendous progress in that space, and you would see a lot of the POA being executed there as well. All right. So I want to talk about the security of data and transactions. This is at the core of how the security is managed. But you'll have to stay with me in terms of, I'm going to build a story here. So kind of pay attention a little bit, and you will be rewarded with the actual transaction itself, and you will have an aha moment. So stay with the thought. All right. Let's first talk about cryptography. I know many people might know it, but I want to give you a very, very simplified version of a cryptography. It's through a public and a private key. So in this particular case, Andy basically wants to send Barbara something. Let's say a secret number, which is 10. Just to give an example. Andy has his public key and a private key, and Barbara has her public key and a private key. Okay, so we've heard that. The public key is basically something that everybody can see, but the private key is something that's super duper secret. Nobody needs to know it except you as a person. So Andy's public key is visible to Barbara. It's all green and good. And Barbara's public key is visible to Andy. It's all green and good. Now, one interesting thought is that the private key is so unique that we cannot crack it. It's like literally very, very high number. It's weirdly, bizarrely high number. It's like if you ran 1 trillion transactions a second, it will take you 1 million universe times to decode it. Whether you believe it or not, just go with the thought. It's a very, very large number. It's actually very complex. The public key and a private key is not that easy that you add one and subtract one. I'm only giving you that as an example so you really appreciate the concept. Think of it, each number is like a 256-bit gibberish number. And those gibberish numbers, the public key and the private key, are created through some fancy algorithm called the signature algorithm. But that's not important. What is important is they have a public key and a private key. All right, now what do we do? Now, Andy takes Barbara's public key, which is multiply by 2 and add E. So dear Andy takes 10, multiplies by 2 and adds E to it. So he says, I'm going to send you 20E. Just stay with me, just kind of focus, 20E. So he sends Barbara 20E, 10 times 2, and he adds E to it, 20E, as an encrypted message. Nobody can see it. It's 20E, something gibberish, right? But it actually means 10. All right, now what do we do? Barbara gets that 20E, and she already has her private key, so she decrypts it, and it becomes 10. So our Andy, who sent 10, number 10 to Barbara, on the wire it looked like it was 20E, but in reality, when Barbara decrypted it, it became 10. So we are all happy, life is good. Now comes a thief. This guy steals that number 20E. Thief does not know Barbara's private key. He has no clue. He can't decrypt 20E to 10. So this guy is now, in his hand, has a number 20E that is completely useless to him. So the cryptography in a public-private key network is a way in which information or data can be sent on a public network. I don't have a super duper pipe between Andy and Barbara, which is encoded. I have a regular traditional garden variety network wire over which I send some message. This is exactly how the world has evolved, and the Enigma machine was designed by Alan Turing. Stuff was being sent by European Nazis and everybody else back and forth, and they were able to decode it from the message itself. That was the Enigma machine. So in order to actually achieve that, you need a lot of computing power. So in the world of example I'm showing you right now, that data, which is number 10, was sent from Andy to Barbara on an open network, but only Barbara could crack the code on it. So with that in mind, I'm going to show you 2 slides. Just keep those in mind. So in the world today, when you look into the world of blockchain, you're familiar with this slide. So I'm going to use the familiar slide so you get the confidence that you're getting this. We know this slide. We know that the application has multiple databases in the world today, and data may not be encrypted, and public key cryptography may not be needed today. So if you look into your average company today, they have data scattered all over the place. Maybe it's encrypted, but it may not be public key cryptography. So if a hacker comes into this firewall, actually he or she can steal this data. Why? Because it may not be encrypted, number one. Number two, it may not have public key cryptography, and the encryption may be so weak that he or she gets it. And all the stuff that we've heard in the news is because of this. It's so vulnerable because of that. Let's look into the blockchain space. First defense is that data is always encrypted. It's like rule of the law. You have to encrypt it. And the public key cryptography means that the data is protected through a public-private key. So even if it's visible, we can crack the code on it. Look at the beauty of it. Even if you see it, you can crack the code on it. Why? Because it's protected by a public key cryptography. All right, there's more actually. In the world of the one company controlled, it's a single point of failure. We have only one point of failure because data is in a location like that. But with blockchain, the data is scattered all over the place, so there's no single point of failure. In the old world, the world today, the data can be changed as it's on one database, or even if it's on 2 databases, it can be changed because the control is with one organization. But in a blockchain space, it is tamper resistant. Even if you want to, you cannot change it because the same block is spread across multiple nodes. You just cannot change it. And last but not the least, there's no detection control that exists that invalidates the data in a traditional. Today, I understand enough about security that I can be dangerous. But there are a lot of controls one can put on the data for detecting anomalies and finding issues. But in the blockchain world, a transaction is saved in the ledger with cryptography and the private key of the creator. Believe it or not, the creator's private key is kept in a way that only if anybody even touches it, changes it, modifies it, it becomes invalidated. So the hacker poor guy comes in from the firewall of into one company, sees the data. It's not, he can't decrypt it. And moreover, even if he's able to modify the data within the ledger B, the private key is going to invalidate it. Look at the beauty of the security here. We are able to distribute the data, prevent hacking across all the nodes. We are able to have public key cryptography that actually protects the data. And all of a sudden, the data becomes gibberish even if you steal it. All right. Now look into how a security of a transaction works. So same guy, Andy, same gal, Barbara. Andy wants to send Barbara 10 Bitcoins. Okay, so he takes Barbara's public key, which is multiplied by 2 and Andy, encrypts it and sends it to Barbara. Barbara uses a private key secretly and decrypts it to 10. We all know that. So the question is, think about it. Let's assume Barbara is a rogue person for the sake of argument, not the thief who's wearing those striped shirt, but Barbara. What if Barbara says that I'm going to change my 10 and make it 50? I have 50 coins, not 10 coins. How do we prevent that? Very simple. Our dear Andy attaches his private key to the 10 Bitcoins that he's sending Barbara. Now, when that occurs, when Barbara got the data from Andy, 10 Bitcoins, she realized one thing, that she can't change it. The moment she changes that 10 to 50, because she had this rogue idea, the record is invalidated. And therefore, it doesn't really work. And if you have a thief who steals the number, he does not know Barbara's private key, and he cannot change it to 1,000 Bitcoins, even though he might want to, but he cannot, because it's tamper-proof, resistant to all of that. All right, cryptocurrency. What is cryptocurrency and wallets? The world that we live in today Basically, we run our lives through dollars and pounds and euros and reals and rupees and yens and all that. That's how we work today. So if you have Kathy, who basically wants to send money to Andy or wants to do her stuff and pay her bills, she probably goes into a bank and opens an account, and now she has an account. Or she's a little bit more creative. She can open up a PayPal account and send the amount directly to Andy. That happens all the time. It's been happening for years now. Okay, or she could actually use a credit card and buy something at the supermarket. Life goes on. This is how we've been working for years. Blockchain. With blockchain, you have multiple blockchains scattered all over the blockchain world. You've got the Bitcoin, you've got Ethereum, you've got a lot of other things, Litecoin, etc. Now, how does it work? So our Kathy basically goes to a company which offers a blockchain wallet. So if he goes to a company like this, I'm not endorsing any of these companies, it just happen to be a few of them. She goes to this company and says, may I please have a wallet? So she opens up a wallet, which is called a cryptocurrency wallet. Now she can have in this wallet anything like a Bitcoin, Ether, depending upon the company she goes to. So she gets a private key, which is her secret that super duper nobody knows. And she has a public key, which is her address, like your address, 123 Main Street. That's your wallet's address. The interesting thing now is that her wallet's address, which is, let's say, 123 Main Street, equivalent to your home, is the address that everybody else can send money to. That is the address of your wallet. So when a money is sent to a public wallet, that address, 123 Main Street, then only Kathy, who lives in that 123 Main Street, or who owns that wallet, has this secret code, a private code, that she can use to decrypt that message. So if you send me those 10 Bitcoins to the Kathy's address, only Kathy can actually decrypt it and see it. And companies who offer that wallet service basically are connected with the blockchain ecosystem. They connect to the Bitcoin and the Ethereum exchange and other exchanges. And they may also be connected through a cryptocurrency exchange, which gives them access to banks, etc. So Andy, sitting in a traditional world, using his bank, can send $10 equivalent of Bitcoin to Kathy's wallet, and the transaction is processed. Similarly, Kathy can use her 1,500 Bitcoins through her wallet, send that to the blockchain network through the cryptocurrency exchange, boom, to Andy's account in a bank. That's how the world works, actually. Andy can send the stuff to Kathy. Kathy can send the stuff to Andy. And they can keep on doing this transaction, basically, without any intermediary. That's how it works. So from a peer-to-peer transaction perspective, when Andy, who wants to send 10 Bitcoins to Barbara through the public key and the private key, and he sent that through the encryption we talked about, Barbara got those 10 Bitcoins, right? Barbara put those Bitcoins in her cryptocurrency wallet. And now Kathy, who just happens to be on yet another blockchain, doing yet another thing in totally different country, Barbara can actually use the blockchain, her wallet, and she could have two wallets. She can use that wallet to send Ether to Kathy. From a wallet to wallet. That's how it works, basically. Okay. That was my thunder. Hopefully you got it. Well, I do want to talk just quickly on what is ICO. People have asked me this question last time. ICO is nothing more than an initial coin offering. It's like people are looking for money, the startups. They basically do an ICO, and they tell people how wonderful they are. And individuals who are hopefully qualified investors will say, "We love you. Here is the money," and that's what the ICO is. It's similar to an IPO, which has been happening for many years, but the ICO is an incarnation in the digital world of blockchain, of raising crowdfunding type of money. There's a lot more to it, but you get the idea. Startups actually create these cryptocurrencies. So I could have my own startup tomorrow morning, and I can call it my super duper coin, MSDC. I can give it a fancier name. I decided to give it a dumb name, so you get the idea. It's up to you. You can call it my dog's chain coins, whatever it is. And you offer X percentage of my super duper coin to investors and say that my super duper coin is equal to 1 Bitcoin, for example, or my 100 super duper coins would be a 1 Bitcoin. About 80% of the ICOs today are on Ethereum platform, and they use the ERC20 token to do the conversion. For those of you interested in ICO, you can look into it, and you can also send me questions. But the idea is that you raise capital, unlike traditional ways of raising capital through the blockchain, and you are able to raise physical capital, actually, besides crypto capital. Okay, so the use of, how does that apply to a peer-to-peer transaction in Transactive Energy, for example? So if you look into a Transactive Energy use case, I actually want to show you a way in which the ISOs, RTOs, producers, consumers, utilities, operations, and blockchain can interoperate with each other using blockchain. So in this particular case, I use the concept of Transactive Energy to inject price signals from the market. Let's say it's an ISO. I inject a price signal into my microgrid, which is my step number one. When I inject the price signal as step number one, I provide awareness to my consumers, which is P for producer, which is a prosumer, and C for consumer. I give them an awareness of the pricing in the electricity market. And these guys can say, okay, I like it. I'm going to pump more energy. So my solar panel is on, and I am pushing energy into the grid, which is number two. And in number three, the consumer can actually place a pre-negotiated price order, or he or she can actually buy via the exchange. But at the end of the day, he or she consumes energy, electricity, which was produced by P as the prosumer or the producer. Now, once that is being consumed and produced, the utility can actually balance some of the delta and remove the kilowatt hours from the producer into the grid, or they have a role to play. People don't understand that, but utilities have a huge role to play in this market of leveraging blockchain, and so do the ISOs. Contrary to some of the other thinking, I think the role will be significant, and also their role itself will change and get augmented. But that's not the purpose of the presentation today. I will have that presentation separately. For today's purposes, there is a balancing of power, which is 4 through the ISO and somewhere with the utility. And then number 5, there's some balancing which is occurring from the operation side, managing load, frequency, and power factor. And then number 6 is the actual smart contract, which basically is keeping track of the consumption of power based upon my previous slide. Peer-to-peer transaction, smart contract is keeping track of the consumption and usage, and the smart contract also does the billing and the settlement. So when Andy bought 3 widgets from Bob, Bob has to pay $3. So when Andy bought 3 kilowatt hours of electricity from Bob, Bob has to pay money to Andy. That's the number 6. And number 7 is the proof of authority. Remember proof of authority? Somebody goes in and validates the transaction. Remember that? Who would do that? Either we have millions of computers doing data mining, or we can have a proof of authority, some kind of a body that we trust in a permissioned blockchain, in a closed blockchain. And that potentially could be a utility, which basically does the proof of authority. It could be another player as well that we trust. But a proof of authority could be one or multiple players, of course. But these are trusted parties. And usually you have POAs, a lot of POAs in the banking industry, for example. And the last thing is the proof of stake. Proof of stake is an algorithm that could be also developed that provides some basic settlement of these transactions. So this is a very interesting example of a peer-to-peer trading in a transactive energy world, which is integrated with the ISO RTO market. And a microgrid provides the ability to execute transactions using blockchain. These are a few use cases that we have been working on, and for those of you who are interested, we can provide you with some additional information. But suffice it to say, many use cases such as peer-to-peer trading, wholesale market settlement, REC carbon trading, energy forecasting, retail billing are prime candidates for blockchain in the utility market. I'm only talking about the electric, but in the oil and gas industry, we also have a number of use cases that we're developing. So just quickly, what are the drawbacks and issues The drawbacks and issues of blockchain are very obvious. There's lack of education or knowledge, so there is a fear factor and the risk of hacking, and the fact that we might get disintermediated. I actually believe that there are answers to all of these, and this today is my way to improve education in the industry and provide the foundational knowledge that's needed for us to think about blockchain as a viable technology. It's just a technology, remember. There's nothing to fear about it. We can use it the way we want to use it as humans and apply that for our cause. That's all there is to it. And we've been doing it for the last 30, 40 years from a distributed computing architecture perspective. One thing that we have to manage from a technology perspective is its large size, because it keeps on growing over the years, over the months, over the years. So we have to figure out an answer how to manage it. And there is one of the biggest issues that we've been looking into is the incompatibility with enterprise systems, the lack of standards, and the lack of integration capability. Like, how do you have applications talk to each other? How do you have blockchains with multiple applications talk to each other? How do you send and receive the data? There's a huge issue of interoperability standards. We just happen to be looking at that as the Energy Blockchain Consortium. All right. I just want to now close the call by bringing some awareness to you. There's a conference coming up on November 1st and 2nd in the Hilton, Orlando, on the Global Power and Energy Blockchain Conference. It's the world's first event. This is my advertisement. And if you are interested in blockchain and how the world of utility will get impacted or changed, please attend this conference and participate in it. We will welcome you. And for those of you who need information, send me an email, or you will see this on the website of the Energy Blockchain by over this weekend. So this is my last slide. Thank you so much. We are on top of the hour right now, and I wanted to close the call by thanking you. I'm going to wait for the Q&A, of course, but I want to close my part of the presentation. And for those of you who are interested in registering for the next webinar, please do so. And I encourage you to join the consortium and get involved on real projects. So let me pause. Back to you, Irfan, for a Q&A time. Once again, thank you so much. Irfan?
Thank you, Tony. And it was very educational, and you really did show us all the pieces of the engine under the hood for blockchain. And I appreciate that, especially the way you have focused it on applications and shown through very simple use cases. I think was very helpful for the audience. So let's now go into the Q&A. Just a reminder for everybody that the presentation slides and the recording link are going to be shared over the weekend. In addition to that, a survey is going to be sent to you, and I would really recommend that you respond to the survey, because it'll give the Energy Blockchain Consortium an idea of the level of interest and how they can serve you better. So please look out for that survey also. So let's start with Wilson Figueroa, who says that he claims there's a false claim. He says, concerns the trustless utopia that blockchain will supposedly create by eliminating the need for financial or other reliable intermediaries. This is absurd for a simple reason. Every financial contract in existence today can either be modified or deliberately breached by the participating parties. Automating away these possibilities with rigid, trustless terms is commercially non-viable, not least because it would require all financial agreements to be cash collateralized at 100%, which is insane from a cost of capital perspective. So that was the first comment.
Okay.
Now, just very interesting, Tony, that his initials read WF, which also stand for Wells Fargo. So go ahead.
Okay. I think it's a good comment. I respect that. I appreciate it. I think we are early in the world of blockchain, like we were in the world of internet in 1994. But I can tell you that there are many contracts that can be created in a trustless environment, because guess what? The people who are creating these contracts are you and I. It's not machines. We are encoding it. The alternative is not to do it. And the other alternative is to do it, but then have people look at it. But what you're doing with a blockchain is you're actually encoding the governance and the execution of the contract in the smart contract itself. So the risk of deviation or variance is minimized or actually eliminated. We are not dependent upon the personalities of human beings to arbitrate the terms of a contract. That's the beauty of it. So the creators, which is you, who's the person who asked the question, or guys like me and other people who create these contracts, can create viable contracts through lots of due diligence. Once these contracts are created, it brings the confidence, and at some point in time, they may get securitized. Now I'm speculating. There is an opportunity to securitize these assets. But I don't want to get into that today. It becomes a little bit of philosophical discussion. But the only thing I would say is that the financial world that we live in today, and I can give you examples, has embraced blockchain. But contrary to the original thinking, where people thought blockchain will disintermediate a bank, that hasn't happened. Instead, some of the premier companies in the blockchain space who are addressing the financial market are thriving because of the opportunity for the banks to leverage blockchain for the purpose what I just told you, which is to have a smart contract that can be executed and governed. So those are the various attributes. So we are in the early stages of that. I can't comment more than that, but I believe there is an early belief that this technology is viable and useful, but it still remains to be seen where it gets applied and whether it's a viable tool for securitization. But we have good early signs, though.
All right. So the next question or comment is from Wilson. Also, he says, is blockchain really making the strides and promises that are claimed? And if so, what is the killer app?
Okay. I'm not a proponent of blockchain. I do believe that I personally have been using distributed computing technologies from day one. I'm actually the original architect of the Open Software Foundation distributed computing environment and the Common Object Request Broker architecture. The original premise of the distributed computing architecture was that we should be able to process transactions in a distributed manner so that you have a bank account in Boston and you can go to San Francisco and withdraw your money. Or even if you withdraw your money in Los Angeles and there was an earthquake, the transactions do not make your transaction viable or non-viable. So all of that capability of distributed computing has been engineered. We live today because of distributed computing architecture. Look at what you do today from your home. You buy and sell. You're buying stuff on different. So I think the value of blockchain is incremental to the distributed computing concept that we have been thriving on for the last 30 years. It's an incremental add to that continuum. It makes it more secure. It makes it more attractive because we reduce the cost of intermediaries. And it makes it very palatable because once it's encoded, it can execute forever. So there are certain positives which are going to add to the distributed computing environment we live in today, but we've been benefiting from it from 30 years. You give me one transaction as an example, I can tell you how it's being executed behind the scenes because I understand enough to say that all the power of distributed computing is basically at the foundational level of the internet. And that's how we are benefiting on a daily basis, hourly basis.
All right. Let's keep the responses short because we have several questions and I'd like to get it done before 11:30 Mountain if possible. So John Greenhill asks, why cannot a Bitcoin which has been stolen be labeled as stolen?
Why it cannot be stolen? I don't know how I do know that from a privacy perspective, if the Bitcoin that gets stolen gets invalidated. Uh, so, so I think there is a level of invalidation that the public key cryptography provides. I think the details of how that's provided is a little bit beyond the scope of this. But I think the private key is something that is very specific to an individual who's the consumer of that Bitcoin. And if that key is not compromised, then the Bitcoin is secure, basically. Otherwise, the Bitcoin can become pilfered, basically.
Next question from Michael Shea. He asks, given the spirit of the blockchain as explained so far, why would any government that has been control-oriented would allow blockchain to prevail for the public?
I think there is a typical fear amongst not only the government but also institutions for disintermediation. But I think one of the things that is surfacing is that disintermediation can only occur for certain transactions, not all transactions. That's number one. Number two, the intermediaries themselves have a lot to gain by delivering more services beyond the obvious ones. So there are two benefits to the intermediaries. One, they can automate some of the transactions without the overhead, which means they probably lose a little bit, but they gain by provisioning more transactions, and therefore everybody is a winner.
Next thing is from Wilson, who gives a URL for an article that talks about Ethereum and smart contracts and says that it contains major security flaws. And then he says, I've read items that say smart contracts have security flaws. Do you have any comment for that?
Yeah, so the security, a smart contract is basically, there could be a couple of security flaws. One is that smart contract must be written in a way that it is validated. One of the biggest risks in a smart contract is the validation of a smart contract. You cannot deploy a smart contract without its validation. Why? Because once it's deployed, it can actually become unchangeable. That's a huge risk. But the second risk that we probably are alluding to is a risk where the following actually occurred a couple of years ago. That because the flaw in security, a rogue user was able to pilfer about 50,000 or some odd number Bitcoins because of a small flaw in the smart contract itself. And that flaw was what I was alluding to in my presentation earlier, that enabled the founder of Ethereum to step in and ask for a correction on the smart contract. So the risk is obvious there. And people who are developing smart contracts have to be cognizant of that risk to make sure that their encoding is done right, basically.
Okay, next we have H.W. Kemp, who says, what incentive is there to verify?
The incentive to verifying is the process of creating a block, which basically is the incentive, the money, the economics drives that work. So for $1 transaction between Bob and Andy, where the transaction was created and it went into a node, that somebody has to validate that. And that validator is, for example, a proof of work data miner or a proof of authority or a proof of stake. So that validator gets, for this $1, he or she gets 0.01 cents. I'm just making it up, but a very small portion. And that's his or her economic benefit in doing the data mining or block making.
Mike Marullo asks, how was the 32 terawatt hour number calculated?
Sorry, can you repeat the question?
Yeah, he's asking about that 32 terawatt hour number that you suggested it would take to crack the code.
Yeah. No. 32 terawatt hour of electricity is consumed to create, that basically is the amount of electricity that powers Denmark is equivalent to the energy used to do data mining, right, for the proof of work. That's what I said. That's what I said.
Oh, because it was in your slide, it was associated with what it would take. And that's why it's so prohibitive for anyone to outdo that as an individual entity.
That is correct. If anybody even attempts to break one of the blocks and makes a change, the change could be like Tony's owed 50 bitcoins, but I'm going to make a change and call it 10 million. That change in a block, I have compromised with the transactions. The way it works is that the private key of the creator says that, hey, this record doesn't look viable anymore, and it gets invalidated. And that block itself doesn't get perpetuated across nodes. So in order for a hacker to make that change, he or she will have to go to all these thousands of nodes to make the change, which is computing-wise prohibitive. And hence, it's difficult to crack it.
Right, because the hash continues into the next block, so they'd have to fix that, and then the next one, and the next one. So, yeah.
It's very prohibitive. Yeah.
There's a neural network aspect to this.
Correct.
Okay. Next, from Wilson, he says, are there competitors to consensus like directed acyclic graph, DAG?
I'm not familiar with that. I am familiar with a number of algorithms which are competing with the POA, POS, and the POW, but I'm not familiar with that particular example.
Yes. It's an interesting acronym, POW, because in a way you're becoming hostage to those entities now.
Interesting.
Okay. I just, my concept of POW is not a pleasant one. How is the energy use needed reduced?
How is the energy use?
How is the energy use needed reduced? So he's asking because, this is becoming prohibitive from an energy perspective. So what can we do? Is there some reduced instruction code or something we can do?
No, I think the problem is going to get exacerbated as the data grows in the blockchain space. So this problem will increase, not decrease. Obviously, the computing power is going to give the capacity for the data miners to manage that. But the answer is not to keep on increasing this. I think there are some alternatives, at least on the permission-based networks, where you can use a proof of stake and a proof of authority. So the bottom line is simple. For a permission-based network, you can use a proof of stake and proof of authority and not have to spend so much energy and money on solving mathematically complex problems. So for permission-based, we have the answer. But for a public, non-permission-based blockchains, the only answer we have is proof of work. And proof of work by design is actually a very interesting and good thing because it provides democratization, decentralization to the network, which means that people don't need privileges. They can become data miners because that is the most autonomous way to validate a block. So it is what it is. We have to come up with a better way, but the consumption of electricity is a big issue there. And yes, from the energy sector, we all know that the integration of the DERs is going to, and the renewables are going to lead to a cleaner world. So our hope is that these data mining companies are using clean energy and distributed energy resources as the way to fuel their computers. That's the hope that I have.
Yeah, so I'm actually carrying on a discussion in LinkedIn these days, and a couple thousand people are following, that's talking about sustainability with modern technology and how these diffuse sources of energy like renewable energy and fossil fuel are not going to cut it for the very high energy use applications like reverse osmosis for water purification, as well as recycling and plasma arc furnaces, and this Bitcoin will need a very dense source of energy in order for it to be sustainable because the footprint would become too large. So the answer is actually a mix of different sources of energy that are carbon neutral and not just depend on renewable energy, because it's not a through street given the material dependence of renewable energy at the mining, fabrication, and end of life. Okay.
Very well said.
Let's move on. Thank you. Next is, can you please again explain about the designing a smart contract and who does it and how the validation happens? So I think we could just go back to the slide. She's left. So you want to say something briefly?
Yeah, I'll just say something. The smart contract is our only tool we have at our disposal in blockchain to encode some business logic that we've been doing for years and years and years. Once you deploy that on the blockchain infrastructure, the middleware, takes control of it and provides its provisioning and the governance of it. And the execution of that is that you want to make sure that it executes based upon what you've encoded. So if there's any anomaly that's detected, it's because of the bug in the smart contract, not because of anything else. So I think that's how smart contracts work. The simpler they are, the better they are. The easier they are to execute. And that's how they work, actually.
Yeah, what I like about this technology is the division of labor, how everyone does what they are good at, and that they have a structure by which they transact with each other so that no one is doing something that they're not very good at. So those who are good at writing contracts do that. Those who are good at validating do that. So everyone is kind of doing their thing. And I like that division of labor.
Yeah, and I think there is one blockchain company focused in the financial fintech market that has actually created a legal type of a verbiage on a smart contract, which I thought was very smart thing to do. So you are able to create the language that people understand, semantically speaking, and then you have smart contract, which is the encoding of that. So I think that is a good step in the right direction.
Yes, discretizing the language of contracts is going to help reduce clerical errors, because you're going to have pre-selected things that you're going to pick from when you have structured language like that. So that will actually hopefully reduce the computational requirements too. All right, next. Can you provide a simple code for the blockchain?
Simple code?
Yes.
Oh, yeah, I think it's all over the map, actually. You can go to Google and do a search on smart contract. You will be able to see a few examples of how to write smart contracts. It's fairly straightforward, actually. It's for those of us who are from a developer background, it should be fairly natural to write a smart contract, basically. But the environment in which smart contract exists requires a bit of configuration and setup, which may be a little bit different for the traditional developers. But the coding itself is fairly straightforward. You can use Java and a few other languages to achieve that.
Yeah, so David was asking about data mining energy use. How do we reduce that? And I guess we've concluded that you just have more entities involved so that the energy use is distributed over more people, but the amount of energy that's used is what is used.
Yeah, and I think my suggestion to that problem will be to do some DER integration in the areas where you have the data mining operations. I think DER integration in a local microgrid will provide the capacity to not depend upon fossil fuel and use that as a technique. In fact, it could even become a good selling tool for the data miners of the future, because that is a concern that people like you and I have, and I think that is a potential answer to that concern.
Yeah, and also in the time frame we're looking at, beyond 2035 and onwards, if you look at the Generation 4 International Forum from the World Nuclear Association, you begin to see designs for small modular nuclear reactors that are fast reactors with lead and sodium, as well as molten salt with thorium, that will provide the dense energy sources that we need to do this, as well as the other applications I spoke about, desalination and recycling. So if you look at the EIA forecast into 2030, 2040, 2050, you still see a significant fraction for nuclear power, even though most of today's nuclear power plants are going to be gone by then, which is DOE's way of saying that if you want to have a clean, low carbon future, you got to have an all of the above approach rather than just talking about DER. Or consider small modular nuclear reactors with refueling with used fuel as a renewable source, or with thorium breeding, and include that in the category of renewable energy sources. So I think it's a very interesting discussion, because what we're finding, as I was saying earlier, is that low carbon, sustainability, and population of 9 billion people simultaneously cannot just happen on solar and wind and batteries. It's just not, it doesn't work out. So it's very important to keep an open mind about some of the innovative technologies that are coming, and look for an optimal point with all of them included. Okay, next. In your P2P energy trading example, what are the benefits of blockchain above and beyond a different secure distributed ledger technology?
In my P2P example, so I am not following the question actually. In the P2P?
It says in your P2P energy trading example, what are the benefits of blockchain above and beyond different secure distributed ledger technology?
I think the benefits are that you can actually create a microtransaction. You don't have to depend upon an intermediary to do the settlement, and your settlement can be efficient instantaneously. Those attributes are missing today, even the wholesale energy market, and we don't have a micro market like this today. So I think having a technology that will provide the simplicity and efficiency and efficacy, I think would be extremely helpful and reduce the burden for prosumers, basically.
Next question is from Hugo Riggs, who says, what ways can a small group use the Bitcoin technology without having a huge access to computing power?
Is the question more around becoming a data miner, or is the question more around using blockchain to solve the problem?
Just using the blockchain, yeah.
I think using a blockchain is a fairly simplistic task. You download the whole stack, which I referred to you. You can download that on your computer. You can download a light version of it and start using it. You will need some way to do integration with it. And there are tools available to do that as well. So I think getting a microcosm of the blockchain running on your local computer should not take you more than a day or 2 days, give or take. And to become a data miner is certainly a larger endeavor that requires a little bit more sophistication, and which is a little bit beyond the scope of today's call. But getting started on blockchain is a fairly straightforward process.
Next question is from Mehran. He says, for real-time application of blockchain in electricity market, how can we use the blockchain with lower mining process?
I think the only answer to that is that we use the permissioned blockchain. So if you look into the ISO RTO market today, look into the ISO RTO in the New England area, you have 550 participants in the ISO RTO market. Now, if we created a blockchain that served that wholesale market, we will have a closed permission-based network with 550 or odd participants. And then we can also have other participants, like, for example, we see in New England. And all of these participants are thoroughly vetted and tested and proven. In this model, you don't have to use POW, proof of work, as your algorithm for creating blocks. You can use proof of authority, proof of stake, as an alternative to creating those blocks. And therefore, you'll be saving a lot of energy through that process.
And Gary Ricard gives you a compliment. He says, nice job, Tony. Excellent overview, educational, and very insightful to how we can improve trust in computing and our transactions.
Thank you for the comment.
Next is Michael Shea says, would there be a way to make sure that there would not be runaway phenomena for POW, POS, and POA, similar to preventing the currently common problem of government becoming so monopolistic and tuning into out-of-control monsters? Ooh.
Yes, that's a very, very good question, actually. And at the heart of blockchain is the process of creating blocks. And if you are able to monopolize that process, then the whole house of cards, if you want to call it, will fall down. So therefore, we cannot let the POW monopolize the creation of the blocks. There is a lot of effort going on to make sure that that monopoly is not possible. So that's my high-level answer. The other answer, using a proof of authority and proof of stake, is a reasonably viable alternative for a permission-based blockchain, because you can control the proof of stake, and you can also control to a certain extent the proof of authority. Because the proof of authority is like a few people get together and say, we value A, C, F, K, and L. You identify those stakeholders up front. So there are built-in features built for POS and POA, but for POW, we are creating the capability to make sure that the network is not hijacked. So that is the only problem that must be addressed. And I don't want to go into the details of it, because I've done some research on a few entities who may or may not have that as their intention, but there is careful watch on that body of work right now. So your question is very valid, actually. But there's a lot of work that has gone on to not let that happen.
So we'll just wrap it up in the next 2-3 minutes, because we are over the half-hour mark. There are just 2 or 3 more left. The amount of storage increases exponentially with respect to the number of blocks as per the distributed ledger. So how can we tackle this in practice? Ravi Kumar is asking.
Yeah, I think the issue of blockchain and using storage is something that is going to increment over time. Let me tell you what we have done as an industry over the last 20 years. There's something called an ILM, Information Lifecycle Management Strategy, where the older data is less important than the newer data. So, for example, your energy data that you consumed 5 years ago is probably less important to you than the energy data you consumed this month. So the Information Lifecycle Management Strategy tells you that the value of the data diminishes over time. Some of those concepts, what I'm telling you is nothing new. This has been in distributed computing for a number of years now. We need to inject the blockchain technology with these newer concepts, or these concepts which have been proven. We have not done that yet as an industry, as people. So the point is valid, but we have to use techniques like that to make the blockchain smarter and more viable when it comes to data, basically.
Last couple of questions. If we want to use the blockchain technology for securing the sensors, data transfers, then periodically at each time step, the data has to be stored at each ledger sensor. Is this feasible in the smart grid, for instance, phasor measurement unit data? Please share your viewpoint. Ravi Kumar.
Yeah, Ravi, that's a very valid question. I actually worked on a synchrophasor project once to do situational monitoring off the grid. And I understand that there's a lot of data that can be created we were collecting data at 100 millisecond interval. So a lot of data. Okay, so having said that, transaction processing is a world that is known to us for the last 20, 25, 30 years. What that means is that I can have an environment where I can run multiple transactions, hundreds, thousands, millions of transactions per hour, per second. So we know that science. That science is known to us. We need to make sure that the blockchain that we are buying, or you are buying and I'm buying, we need to make sure that blockchain has enough distributed computing transaction processing capability built into it so that it's able to handle those transactions. Just one more thought. In your particular case, if you decide to pump all these transactions into a blockchain, you may want to use an integration tool such as a middleware. If you have any questions, you can send me an email. I'll help you on that. But you can use an integration tool to be able to pump these transactions into the blockchain. So you will have two things. One, a ramp into the blockchain and the ramp out to go out of the blockchain. So you want to use that as your approach to bring in and take out the data, basically, as an example.
David Katz asks, what is the IBM blockchain used for Electra Utility Pilot with IESO and INTEAC in Ontario?
I don't want to comment specifically on a particular example because I may not have the broad knowledge to comment on that, basically, and for other reasons. So.
Ravi Kumar, last question. In practice, what is the periodicity for updating the distributed ledger for every block?
What is that?
What is the periodicity? How often?
Oh, how
for updating the distributed ledger? Yeah.
I think the periodicity of distributing of creating these blocks is dependent upon the voracity of the data and the ability to create these blocks. So in the Bitcoin world, I think it's like 10 minutes or something like that. But I think our goal as a society, as an industry, is to use, for example, techniques where it comes down to microseconds or milliseconds. So we are getting there. It's not like this is 5 years away. Today, you can have a blockchain that can process synchrophasor transactions at a millisecond level, as long as you have the right architecture, which I proposed to you a few seconds ago. So there are ways in which you can process transactions if you're smart about it, using the right architecture. But we are able to create blocks now in seconds in a permissioned network, basically. Not on a public network yet, but on a permission network yet.
Wonderful. So at this time, I just would like to thank Tony for your very informative presentation and for the Q&A. And the next webinar, as Tony mentioned in his presentation, will be on Friday, August the 3rd. You're going to receive an invite, just like you did for this webinar. All the slides, the recording, everything, and a survey is going to be sent to you over the weekend. Be on the lookout for that. Any final thoughts, comments, Tony, before we bring this to a close?
Irfan, I do want to thank you for your excellent moderation and keeping me online. So I appreciate everything you've done. I also want to thank all the participants. Many of you have still hung around. I really, truly am blessed to have people who are on the hearing side. So thank you for your time. And also one last thing, if you have any questions, feel free to send them. You have my email, and I'll do my level best to respond to it. So thank you again for your time.
Thank you very much. And at this time, the recording is coming to a close. Enjoy your weekend, everybody. Thank you.